So I look at home buying very differently than the majority of people. I look at buying a home the way I buy a shirt. For me, a home is not an asset, it's a liability. So what does that mean? I want to buy a home because I want to create memories.
Yes.
I want to buy an investment property or an investment because I want to make money. So if you're buying a home because you think, oh, I want to get rich because of my home, I think you're looking at it the wrong way. Because you should be looking at your home as, I want to make memories here, I want to live here, and I want to grow my family here, and I want to spend time here. If that's the reason why you want to buy a home, what you should be paying attention to is not what's going on in the markets, not what's going on with interest rates, but instead what you should do is say, can I afford it?
Right.
And what does that mean? Can I afford the down payment? Can I afford the monthly payment?
Property taxes.
Can I afford the property tax?
The fix-ups.
The fix-ups. So if you can afford it, then you buy. If you can't afford it, if you're stretching yourself too thin, you don't buy. Because what happens to so many people is you get sucked into trying to time the market. But again, if interest rates drop and you own a home, you can refinance.
Right.
And so make sure you can afford it. That's the biggest thing. You have to be able to afford it, because if you are stretching yourself too thin, going paycheck to paycheck, you're hurting yourself, because now what you're doing, you don't have the ability to invest in other places. If the Fed cuts interest rates when we go into a recession, so our economy slows down, the Fed starts cutting interest rates, mortgage rates go back down, you're gonna see a bigger flood of cash into the housing market, and that will create a bigger wealth gap, and it will make it significantly more difficult for the regular person to buy a home. Home ownership will become a real American nightmare, because it will be so difficult for the regular person. We will turn into essentially a renter nation.
Wow.
Where homes are owned not even by regular investors,
by corporations.
But corporations. Yeah. They're buying 1 out of every 4 homes in certain neighborhoods. I look at the home like a liability. Can you afford it? Yes, then buy. If not, then don't stretch yourself too thin. I used to be a real estate salesperson. And the reason why this is so important is because when I was a salesperson, what they say is, you want to tell people this is their biggest investment of their life. So buy a home that you love. Now, again, real estate agents are not bad people. Bankers are not necessarily bad people. However, you have to understand the messaging. If I tell you this is the biggest investment of your life, what are you going to say? I want something bigger. I'm willing to stretch a little bit thinner. I'm willing to go a little bit further because I want that home. And so what does that do? Well, it makes the banker richer. It makes the real estate agent a bigger commission check, and they walk away, and now you have to deal with it. If you can afford it, great. But if you start to struggle with it, you're the one that has to deal with the problem by yourself. And so what happens for so many people is your home is a money pit until you sell it. And then you have to hope that you sell it for a profit, because there's no guarantee, right? We don't know where home prices are going to be in 5 years or 10 years. I can't predict that. I don't know what the Fed is going to do. And so the main thing that you have to understand if you're thinking about buying a home is ignore the markets, ignore what's going on in the world. Can you afford it today? And please do me a favor, okay? I very rarely try to tell people what to do, because I feel like, I want you to be educated so you can make smart decisions for yourself. But the one time that I really tried to give people, like I say, don't do this, is when it comes to adjustable rate mortgages, because they've been making a huge comeback now. Because now the interest rates are 5.5%. People say, I missed out on the opportunity to get a low mortgage. And now I have been seeing a huge growth of adjustable rate mortgages, because now banks will say, don't pay 5.5% on a home, pay 3.7% today, and it's a 5-1 arm. Meaning, after 5 years, it's gonna readjust. And then your mortgage payments will readjust. And if it goes higher, don't worry, you can just refinance out. And it is so risky because we don't know where interest rates are gonna be. If they go up, and they go up significantly, and now you're like, oh my God, let's just say mortgage rates are 10%. I don't wanna pay 3 times more for my mortgage, from $800 a month to $2,400 a month. I can't afford that, so let me refinance. Well, if you do that and home prices have dropped and you can't refinance because the bank says, well, you don't have enough equity in the home, I'm not gonna refinance you. And then you can't sell because you're underwater, well, now you're in a tough situation. So pay a little bit more, get that fixed rate mortgage, because if mortgage rates do drop, refinance.
Right. And
lock it in, because other countries in the world don't always even have the option to do a 30-year fixed.
Right.
We do. But an adjustable rate mortgage is significantly more risky. The only time that I would say an ARM is okay is if you are like 100% confident that you're gonna be able to pay off the home during that initial teaser rate. Because if you cannot, then you are taking on a huge gamble with the home that you live in, with your family's livelihood. It's one thing if you do it with an investment, but with the home that you live in, avoid that extra risk and just lock in the rate, please.
Right.
Right now, the Fed is working to fight inflation.
But how? It's like 8-9%.
They're raising interest rates and they're going to start selling off their balance sheet. So the Fed balance sheet is around $9 trillion.
Crazy.
And so starting in June, they're going to start selling off these assets while raising interest rates. And the Fed says that they're willing to fight inflation because the economy is so strong and robust. And because the economy is so strong and it can withstand any sort of interest rate hikes. So what is the Fed doing in essence? They're pulling money out of the economy. And now they're hoping that the economy will continue to stay strong. So by raising interest rates, what's happening? Housing is becoming significantly more expensive. And
housing or rent? Like buying a home or renting?
Both of them.
Yeah.
Rent costs have gone up by 20%. Buying a home has gone up by even more. And I'll tell you why. Because when people talk about home prices, what do they talk about? They say, oh, well, home prices are up 20% from a year ago. But your housing cost is significantly more than 20%. 1 year ago, you wanted to buy a home for $500,000. You could get a mortgage for 2.5%, 30-year fixed.
Right.
So $100,000 down.
Yeah.
You could borrow
$2.5%.
$400,000 at 2.5%. It would cost you something between $1,600 and $1,700 a month.
It's not bad.
Today, that home is not $500,000, it's $600,000, 20% more, and your mortgage rate is not 2.5%, maybe 5.5%. So what does that mean? If you put 20% down, you're not putting down 100 grand, you're putting down 120 grand. And you're not financing $400,000, you're financing $480,000. So you have to borrow more dollars, and then you're borrowing the dollars at a higher interest rate. So you're not borrowing at 2.5%, you're borrowing at 5.5%. So now your mortgage on that same house, the exact same house, assuming no upgrades, has gone from $1,600, $1,700 a month to $2,400, $2,500, $2,600 a month. So your housing cost is significantly higher. So now with interest rates going up, what's happening? People are saying, oh my God, homes are significantly more expensive.